The United States housing market is currently carrying a hidden loss of approximately $900 billion, not projected, not forecast, calculated right now from the gap between what banks have on their books and what those properties would actually trade for in an open market today. This number does not appear in any Federal Reserve press release. It does not show up in the FDIC's quarterly summary. It lives in the loan files of 4,700 regional and community banks across the country, marked at origination value, untouched since the day the ink dried. The official story is that housing remains resilient, prices are holding, the consumer is stable. But the official story is built on a specific accounting choice, not economic reality. And that choice is now colliding at full speed with a wall of $1.5 trillion in commercial and residential real estate debt that matures before the end of 2026. This is not a crash in the way the media defines crashes. There are no headlines yet. There are no bank runs on the evening news. What is happening is structural. It is mechanical. It is the slow recognition of losses that were always there, hidden under a policy environment of near zero interest rates that no longer exists. The question is not whether those losses get recognized. The question is when and who absorbs them. Before we walk through the specific mechanics of how this recognition happens and what it triggers when it does, understand what this channel focuses on. Not predictions, not panic. The structure of capital flows, the incentives of institutions, and the mathematical consequences of leverage when the rate environment shifts. Those mechanics are what determine outcomes in real estate markets. Headlines do not move buildings. Debt maturities do. The starting point for understanding what is hidden is the concept of extend and pretend. When a commercial real estate loan matures and the borrower cannot refinance at current rates, the lender has two options. Option one is to take the property back, market to market, and absorb the loss on the balance sheet. For a regional bank carrying that loan at $40 million when the property is now worth $18 million, that is a $22 million hit to capital. Depending on the size of the bank, that single event can breach regulatory capital requirements. Option two is to grant the borrower a 12 to 18-month extension, collect the interest, and hope the rate environment improves. Option two does not fix the math. It postpones it. And as of the first quarter of 2026, the volume of extended loans sitting inside regional bank portfolios has reached levels that the Federal Reserve's own financial stability report described as an area of elevated monitoring. That is the language regulators use when they are watching something they cannot yet say out loud. The scale of this problem is specific and it is large. According to data from the Mortgage Bankers Association, approximately $929 billion in commercial real estate loans were scheduled to mature in 2024 and 2025 combined. A significant portion of those did not refinance. They extended. That extension wave is now compounding into 2026, creating a maturity wall that is wider and higher than any single prior year. The properties underlying these loans are primarily office buildings, regional shopping centers, and older multifamily apartment complexes purchased at 2021 and 2022 valuations. Those valuations were built on a specific assumption: that cap rates would remain compressed near 4%, that vacancy rates would stay low, and that rent growth would continue at the pace set during the pandemic stimulus period. All three assumptions have since broken. The office sector is the most visible example of this structural break. National office vacancy rates crossed 20% in 2024 for the first time since data has been tracked in the modern era. In San Francisco, vacancy rates in the central business district exceed 35%. In downtown Chicago, they sit above 26%. In Manhattan, which is the strongest major office market in the country by absorption, vacancy still hovers near 18%. These are not cyclical fluctuations. They reflect a permanent behavioral shift in how knowledge work is organized. Hybrid and remote work arrangements have reduced the average space requirement per employee by an estimated 30 to 40%, according to JLL's 2025 Global Real Estate Outlook. Companies are not returning to full-time office occupancy. The leases signed during the pandemic period are expiring, and tenants are not renewing at the same square footage. When a building's income drops because tenants downsize or leave, the net operating income falls. When the net operating income falls below the debt service payment, the building is technically insolvent. The loan it carries becomes what lenders call non-performing. The scale of non-performing office debt in the United States is currently estimated by the National Bureau of Economic Research at between $250 billion and $400 billion, depending on the cap rate assumption used to value the underlying assets. That range is wide because nobody is transacting. Transaction volume in the office sector dropped 74% from its 2021 peak through the end of 2025. When nothing sells, nobody has to mark anything. The hidden loss exists in the silence between bids and asks. This is where the 90% hidden figure in the title comes from. It is not arbitrary. It is the structural consequence of illiquidity. In a liquid market, losses get recognized in real time as prices move. In an illiquid market, losses accumulate inside the balance sheets of whoever is holding the debt, invisible until a forced transaction reveals them. The AT&T Tower in downtown St. Louis, a 44-story building, sold in late 2024 for $3.6 million. Its previous sale price in 2006 was $25 million. That is a 98% decline over 18 years. The building did not physically change. Its structural utility remained. What changed was the demand for office space in a mid-sized American city and the cost of borrowing to own it. The math expressed itself as a number that most people, when they first hear it, assume is a typo. It is not a typo, and that same math, scaled to thousands of buildings across hundreds of markets, is what is sitting inside the loan books of regional banks right now, waiting for a transaction to make it visible. The residential side of the market carries a different but equally significant form of hidden pressure. The lock-in effect is the most misunderstood dynamic in the current housing market. Approximately 62% of all existing mortgages in the United States carry interest rates below 4%, according to data from the Federal Housing Finance Agency. The average 30-year fixed mortgage rate as of early 2026 is approximately 6.9%. A homeowner with a $400,000 mortgage at 3.25% pays roughly $1,740 per month in principal and interest. That same loan at 6.9% costs approximately $2,640 per month. The difference is $900 per month or $10,800 per year. That locked-in homeowner has a powerful financial incentive never to sell. And because they are not selling, inventory remains historically low. Because inventory is low, prices have not corrected despite affordability reaching its worst level since at least 1984, according to the National Association of Realtors Housing Affordability Index. This creates what economists call a frozen market. Prices appear stable on the surface because there are very few transactions occurring. But stability built on the absence of sellers is not the same as stability built on the presence of buyers. The buyers are not there. Mortgage applications for home purchases as of late 2025 were running near their lowest level since 1995. The market is not in equilibrium. It is in suspension. And suspension ends when the forces that created it change, which they inevitably do because of what economists call the 4 Ds: death, divorce, debt, and displacement. Life events that force asset sales regardless of interest rate incentives. Those events are increasing in volume as the economy weakens. The affordability calculation is worth walking through precisely because the numbers are specific. The median home price in the United States as of the fourth quarter of 2025 was approximately $419,200, according to the Federal Reserve Bank of St. Louis. A conventional 30-year mortgage on that purchase with a 20% down payment of $8,340 leaves a loan balance of $335,360. At 6.9% interest, the monthly principal and interest payment is approximately $2,213. Adding property taxes at the national average effective rate of approximately 1.1% adds another $384 per month. Homeowners insurance, which has increased an average of 21% nationally in 2025 according to S&P Global Market Intelligence, adds approximately $200 per month on that property value. The total monthly housing cost reaches roughly $2,800 before utilities or maintenance. The median household income in the United States is approximately $80,610 per year, or $6,707 per month gross. That means the median-priced home consumes 41.7% of median gross income. The standard lending threshold for housing affordability is 28%. The market is not slightly above that threshold. It is 49% above it. This gap is not a market signal that prices need to fall modestly. It is a structural affordability break of the kind that historically precedes significant price corrections. The only comparable period in modern American housing history was the 2006 to 2007 peak before the last major correction. The difference in the current cycle is that the affordability break is being masked by inventory constraint rather than manifesting immediately in price declines. That masking effect is the mechanism behind the hidden crash. The correction is being delayed, not canceled. Insurance is the accelerant that most analysts are still underweighting. The story of American housing affordability in 2026 is not primarily a mortgage rate story. The mortgage rate is visible and discussed. What is less discussed is the parallel cost shock occurring inside homeowners' escrow accounts due to insurance repricing. State Farm, Farmers Insurance, and Allstate have non-renewed or significantly restricted their homeowner insurance offerings in California, Florida, Louisiana, and parts of Texas. These are not fringe insurers. These are the first, third, and fourth largest personal lines insurance carriers in the United States by market share. Their withdrawal from these markets is not a business decision made in isolation. It is a response to actuarial reality. The models that priced risk in coastal and wildfire-exposed markets were built on historical loss data that no longer reflects forward-looking loss probability. The financial consequence for homeowners who remain in these markets is severe and direct. In Florida, the average annual homeowner's insurance premium has increased from approximately $1,188 in 2019 to over $6,000 in 2025, according to the Insurance Information Institute. In some coastal counties, premiums exceed $15,000 annually for homes that would have been insured for under $3,000 a decade ago. For a homeowner in Broward County, Florida, with a $350,000 mortgage, the insurance cost alone now represents a monthly payment larger than the principal and interest on a mortgage originated at 2020 rates. The property has not changed. The structure of the insurance market around it has. The critical link to housing value is lender-required insurance. To maintain a mortgage, a homeowner must maintain insurance. If the private market withdraws and the state insurer of last resort, the Citizens Property Insurance Corporation in Florida, the FAIR plans in California, becomes either unavailable or unaffordable, the property becomes unmortgageable. An unmortgageable property can only be sold to a cash buyer. Cash buyers, typically institutional investors, will not pay retail market prices for assets carrying structural liability. They require a discount. The moment a significant number of properties in a neighborhood become unmortgageable, the comparable sales data for that neighborhood resets at a structurally lower level. Every remaining property in that neighborhood reprices. This is not a gradual adjustment. It is a discontinuous drop. The banking exposure to this dynamic runs through the escrow system. Lenders collect insurance premiums monthly through escrow accounts and pay them annually to the insurer. When a policy is non-renewed and the homeowner cannot find replacement coverage at a comparable price, the escrow shortfall triggers an escrow analysis. The lender then requires the homeowner to cover the shortfall immediately or increase the monthly payment. For a homeowner who bought in 2021 with minimal equity at maximum debt-to-income ratios, a $3,000 to $5,000 annual increase in insurance cost is not absorbable. It becomes the event that breaks the household budget and initiates the default process. This channel from insurance repricing to mortgage default is not hypothetical. It is visible in delinquency data in Florida and Louisiana, where 90-day delinquency rates on mortgages originated between 2020 and 2022 in high insurance cost zip codes are running at rates approximately double the national average. Now, the risk aggregates into the banking system through a path that most observers are not tracking. Regional and community banks hold approximately 70% of all commercial real estate loans in the United States, according to the Federal Deposit Insurance Corporation. They also hold a disproportionate share of residential mortgages in high-risk insurance markets because the large national banks, learning from 2008, have higher geographic diversification requirements. This means the banks most exposed to insurance-driven housing depreciation are the same banks already managing extend and pretend loan portfolios in their commercial books. The dual pressure is not coincidental. It is the product of the same macro policy cycle. Cheap money from 2010 to 2022 encouraged risk concentration, and the rate normalization of 2022 to 2024 made that concentration dangerous. The FDIC's most recent problem bank list, published for the fourth quarter of 2025, contained 66 institutions with combined assets of approximately $87 billion. That is the official list. The institutions that meet the criteria for formal problem designation but have not yet been added represent a broader shadow list that banking analysts estimate at several times larger. The formal designation process involves examination cycles that can lag reality by 12 to 18 months. By the time a bank appears on the official problem list, it has typically been in structural distress for over a year. The dynamic that accelerated the 2023 bank failures, specifically the speed at which depositor confidence can collapse in the digital banking era, has not been addressed by any regulatory reform since Silicon Valley Bank. The FDIC's bank resolution process was designed for an era when a bank run developed over days as depositors physically queued at branches. In 2023, $42 billion left Silicon Valley Bank in 10 hours. The transmission mechanism was smartphones. Depositors above the $250,000 insurance limit received information from Twitter, moved by app, and were followed immediately by other depositors who saw the social signal. This dynamic is not a historical anomaly. It is the new operating condition of the banking system. And the regional banks most exposed to commercial real estate and insurance market housing stress have not meaningfully improved their liquidity positions relative to their uninsured deposit concentrations. The credit market is transmitting this stress through corporate borrowing as well. The S&P Global Ratings Leveraged Commentary and Data Group reported that corporate default rates in the United States rose to 4.9% in 2025, the highest since 2009. Approximately 40% of the companies in the Russell 2000 Small Cap Index are currently unprofitable, meaning they are sustaining operations through debt. That debt was originated at near zero rates between 2019 and 2022, with maturities concentrated in 2025 through 2027. As those maturities arrive, companies that cannot generate positive free cash flow at current borrowing costs face the same binary choice as commercial property owners: inject new equity or surrender the asset. For a business, surrendering the asset means bankruptcy. The Chapter 11 filing rate in 2025 exceeded the 2009 post-financial crisis pace by a measurable margin according to Epic Systems bankruptcy data. This is not visible in the unemployment rate because the early stages of corporate distress manifest as hiring freezes and reduced hours before they manifest as mass layoffs. The labor market data lags the credit market data by approximately 2 to 4 quarters. The consumer is carrying the weight of all of this through a debt structure that has reached its limit. Total credit card debt outstanding in the United States crossed $1.17 trillion in the third quarter of 2025, according to the New York Federal Reserve Consumer Credit Panel. The average interest rate on revolving credit card balances is approximately 22.8%, the highest on record. At that rate, a household carrying an average balance of $6,500 is paying approximately $1,182 per year in interest alone. More significantly, the share of credit card balances transitioning into serious delinquency, meaning 90-plus days past due, rose to 11.1% in 2025, the highest since the Federal Reserve began tracking the current series. When credit card delinquency rises, banks tighten underwriting standards. When underwriting tightens, the marginal consumer loses access to credit. When marginal consumers lose credit access, consumption slows. Consumption in the United States accounts for approximately 68% of gross domestic product. The chain is mechanical and it is already in motion. The auto market is the consumer sector that most clearly illustrates the endpoint of leveraged consumption. The average monthly payment on a new vehicle loan in the United States reached $738 in late 2025, according to Experian Automotive. The average loan term is now 72 months. At those terms, at current rates averaging approximately 8.7% for new vehicle loans, the total interest paid on a $40,000 vehicle over 72 months is approximately $12,000. Used vehicle prices have fallen 22% from their 2021 pandemic peaks, according to the Manheim Used Vehicle Value Index. The result is that a significant share of auto loan borrowers, estimated at approximately 25% of outstanding balances by TransUnion, are in a negative equity position. They owe more than the vehicle is worth. This population cannot exit their loans through sale. They are structurally locked in, and when income pressure increases, they stop paying. Subprime auto delinquencies of 60-plus days, as tracked by Fitch Ratings, reached 6.56% in November 2025, the highest level in the agency's data series going back to 1994. These are not disconnected data points. They are nodes in the same network. The commercial real estate loss sits inside the regional bank. The bank's capital constraint limits its ability to absorb new consumer credit losses. The consumer credit losses arrive as households absorb the joint cost shock of insurance, housing payments, auto costs, and food prices. Each system is applying pressure to the others simultaneously through the shared medium of the banking system's credit capacity. The municipal finance layer of this structure deserves specific attention because it is the least discussed and the most lagging indicator. Cities fund services through property tax assessments. In jurisdictions where commercial real estate values are repricing downward by 40 to 70%, the property tax base is contracting. The city of San Francisco is projecting a cumulative budget deficit of approximately $1.2 billion over the next 3 fiscal years, driven primarily by the collapse of its commercial property tax base and the exit of retail and office tenants from the downtown core. The Chicago metropolitan area is managing a combined municipal pension liability of approximately $42 billion against a tax base that is structurally challenged by both commercial vacancies and ongoing middle-income population outmigration. Municipal bond investors have historically treated these credits as near risk-free because cities have the power to raise taxes to meet obligations. But that power has a practical limit when raising taxes accelerates the economic contraction that caused the fiscal shortfall. Detroit understood that limit. The question in 2026 is which cities are approaching it. The pension system is the transmission mechanism that connects commercial real estate distress to the retirement security of public sector workers. State and local government pension funds in the United States hold approximately $4.5 trillion in assets, according to the Federal Reserve's financial accounts. Approximately 8 to 12% of those assets are allocated to real estate, with a portion sitting in commingled funds that hold commercial properties marked at appraisal values rather than transaction values. When properties sell at 50 to 80% discounts to appraised values, those fund marks are retroactively revealed as fiction. The pension fund reports lower returns, which increases the required annual contribution from the sponsoring government entity, which further strains the municipal budget that is already contracting from a declining tax base. The retirement of a public school teacher in Philadelphia is connected to the vacancy rate in a San Francisco office building through this chain. The chain is not visible to the teacher. The mechanics operate entirely out of sight, which is precisely the definition of hidden. The Federal Reserve is in a position of constrained optionality that represents a departure from its historical operating range. The central bank raised the federal funds rate from near zero to 5.25 to 5.5% between March 2022 and July 2023, the fastest tightening cycle in 4 decades. That rate increase was the direct cause of the commercial real estate repricing, the mortgage lock-in effect, and the increase in corporate borrowing costs that produced the current default cycle. The Fed has since made modest reductions, but as of early 2026, the federal funds rate remains sufficiently elevated that refinancing distressed commercial properties remains structurally unworkable for most borrowers. The Fed cannot cut rates aggressively to relieve this pressure because the Consumer Price Index, while below its 2022 peak, has proven stickier than the Fed's projections at the 3 to 3.5% range, above its 2% target. Cutting rates prematurely would risk re-accelerating inflation. Maintaining rates will extend and deepen the credit contraction in commercial real estate and consumer finance. There is no path through this that does not involve a significant absorption of loss by some sector of the economy. The instrument through which this resolution will most likely occur is not a dramatic crash event, but a protracted repricing. Properties will be sold at distressed prices as extensions expire and bankruptcy filings force liquidation. Banks will absorb losses against capital, reducing their lending capacity. The reduction in lending capacity will slow construction, reduce transaction activity, and further suppress prices. This cycle plays out over years, not months. The Japanese real estate correction after 1991 took 15 years to fully express. The American commercial real estate correction of the current cycle is not likely to be that extended because the United States does not practice the same degree of regulatory forbearance as Japanese banks did in the 1990s, but the correction's duration will be measured in years, not quarters. And its aggregate size, based on the current gap between book values and transaction values across the commercial sector, is estimated by Green Street advisors to exceed $600 billion in loss recognition before the market reaches a clearing level. The data center sector is frequently cited as the exception to commercial real estate distress, and it is worth understanding why it is the exception, because that understanding illuminates what makes everything else vulnerable. Data centers attract capital because they produce essential, contracted, recurring revenue tied to the physical infrastructure of the digital economy. The demand for compute capacity to train and run large-scale AI models is growing at a rate that is measurable in multiples of available existing supply. Northern Virginia, which contains the highest density of data center capacity in the world, has effectively zero available land for new development in its primary corridors. Hyperscale operators, including Microsoft, Google, Amazon, and Meta, are signing 20-year power purchase agreements and ground leases because the supply constraint is real and the demand curve is steep. This is the exact opposite structural dynamic from office buildings: contracted long-term income, essential service demand, and supply scarcity. The bifurcation of real estate performance in the current cycle is not random. It is the expression of a simple principle. Assets that produce essential contracted income retain value. Assets that produce discretionary, variable, or declining income lose value. Office buildings that depended on the assumption of full occupancy represent the latter. Data centers represent the former. Most of the $21 trillion U.S. commercial real estate market sits much closer to the former category than the latter. The policy decisions that will matter most in the next 18 months are not rate decisions. They are regulatory decisions about how strictly banks will be required to mark their real estate assets to market. The Basel III Endgame rules, which were proposed by U.S. bank regulators in July 2023 and have since been substantially revised following industry pushback, would increase capital requirements for large banks by an average of 16%, according to the Federal Reserve's own estimates. Higher capital requirements reduce lending capacity. In a market where lending capacity is already constrained by existing unrealized losses, additional capital requirements function as a brake on credit creation. The timing of these rules' implementation will shape the pace of the commercial real estate repricing more directly than any Federal Reserve rate decision. Banks with knowledge of stricter capital rules in their future have an incentive to clean their balance sheets now, which means recognizing losses on underwater loans now, which accelerates the repricing cycle. The direction of this regulatory variable is toward stricter enforcement, not looser. That direction has been consistent through both recent administrations, which means it is structural, not political. What the data is showing, when you read it structurally rather than through the lens of any given quarterly report, is a market in the process of recognizing losses that were incurred during the cheap money period. The recognition is occurring unevenly because illiquidity allows delay, but the maturity wall is forcing transactions, and transactions reveal price. Every quarter that passes in 2026 adds new data points to the price discovery process. Office buildings in Denver trading at $85 per square foot when their carrying value on a bank balance sheet is $210 per square foot. Apartment complexes in Austin with floating rate debt being handed back to lenders because the rent growth that was underwritten at 8% per year is running at negative 2%. Retail centers in secondary markets finding no refinancing market at any rate because lender appetite for the asset class has effectively disappeared. The process is unfolding in the data. The delinquency rates are rising. The special servicer volumes are increasing. The bankruptcy filings are accelerating. The FDIC problem bank count is growing. Each of these indicators is a lagged measure of damage that was done earlier in the credit cycle. The peak of that damage occurred in 2022 when rates rose and asset values fell simultaneously. The reporting of that damage is arriving now in the loan review cycles, the refinancing requests, the lease renewal failures, and the insurance non-renewals. What happens next depends on 4 variables: the trajectory of interest rates, which determines the cost of refinancing; the pace of office market releasing, which determines whether vacancy rates stabilize or continue to rise; the speed of regulatory enforcement on bank capital standards, which determines when losses move from hidden to recognized; and the political appetite for a bailout mechanism, which determines whether losses are allocated to equity holders and creditors through market processes or socialized through fiscal and monetary intervention. All 4 of these variables are currently in play. None of them are resolved. The data will continue to arrive in the coming quarters, and each new data point will narrow the range of outcomes from the current wide distribution to a tighter one. The housing market in the United States is not on the verge of a sudden visible event. It is in the middle of a structural repricing that is running through channels most people do not monitor: insurance escrow adjustments, bank loan extension approvals, special servicer transfer rates, commercial mortgage-backed securities delinquency reports, and municipal budget revisions. The 90% that is hidden is not hidden by conspiracy. It is hidden by the natural lag between economic reality and its expression through accounting, regulatory disclosure, and market transaction. That lag is closing. The timeline for closure is the $1.5 trillion maturity wall that does not care about accounting convention or political preference. It arrives on a schedule determined by the original loan documents. Those documents are currently sitting in origination files at 4,700 regional banks, and they have due dates. The data on what those due dates produce will be available to anyone watching the right indicators over the next 4 to 6 quarters. The system is not collapsing, it is adjusting, but the adjustment has a specific scale, a specific mechanism, and a specific timeline. And the timeline has already started. If the analysis in this video is consistent with what you are seeing in your own financial data, there will be more detailed work on the specific sectors and institutions most exposed to this repricing cycle. The process is still unfolding.